And now we look at the introduction. The Basel Committee on Banking Supervision, or BCBS, acts as the main global standard setter for banking regulation, giving supervisory authorities a platform for regular cooperation. And the purpose of this presentation is to walk you through the historical background, objective, and evolution of the BCBS. Well, we'll cover everything from Basel 1, Basel 2, and Basel 3, and it's connected and its connection to Islamic banking to key that implementation challenge a supervisory reflection. Overall, the core focus of the community is setting baseline standard for banking supervision, enhancing global risk management and capital adequacy, and protecting systematic stability through solid framework. Okay, moving on to the background of Basel Committee on banking supervision. Essentially, the committee was born out of crisis specifically, and the series of market disturbance and the collapse of bank house Herstatt in West Germany back in 1974. To tackle this, the central bank governors of the G10 countries come together late that year to establish it, and it's permanently housed at the Bank of International Settlement in Basel, Switzerland. So the main goal was simple yet critical, which bridge regulatory gaps, protect financial stability, make sure cross-border banks are properly supervised, and stop financial contagion and spreading globally. While it started as a small group G10 nation, and it has grown substan over time and now includes senior banking supervisor and central banker from jurisdiction and well beyond the original founding countries.
Moving on to our first objective, which is to prevent a financial crisis and systematic risk. The BCBS guidelines ensure that banks maintain strong capital buffer to absorb losses during a crisis. This prevents a domino effect where the failure of the large bank could collapse the entire global economy. Next, we have boosting public and market confidence. The certain standards adhered by banks under the supervision of BCBS provide confidence to depositors, investors, and financial markets that the bank system is sound and transparent. Moving to the third point is global competitiveness by setting uniform capital and liquidity standards across different countries. BCBS prevents banks from making unhealthy profits through reducing the cost of legal compliance, thus creating fair competition for international banks. And finally, more systematic risk management. The BCBS framework covers credit risk management, market risk, operation risk, and liquidity risk. Ensure banks are prepared for various forms of modern financial threats, including digital and climate risk.
Today I want to talk about the roles and functions of BCBS, which is the BCBS is Basel Committee on Banking Supervision in Finance. Okay, the BCBS has several important roles and functions in the banking sector. First, it strengthens bank supervision by helping countries improve the way they supervise banks. Second, it encourages international cooperation between countries and banking authorities. The BCBS also develops global banking standards, such as Basel Standard, to make banks safer and stronger. It improves risk management by encouraging banks to identify and control risks such as credit and market risks. Another function is setting minimum capital requirements. This means banks need to have enough capital to cover possible losses. The BCBS also helps promote financial stability by reducing the risk of bank failures and financial crises. Finally, the BCBS monitors the implementation of Basel standards to see whether countries are applying the standards properly and consistently.
Now, let's look at Basel I. Basel I is an international banking framework introduced in 1988 by the Basel Committee on Banking Supervision. Its main purpose was to make sure that banks had enough capital to cover the risk they were taking. The main requirement was that banks should maintain at least 8% capital relative to their risk-weighted assets. In simple terms, Basel I acts as safety buffer for banks. It was implemented in 1992 and became the foundation for the bank development of Basel II and Basel III. However, Basel I had a limitation because its risk classification was quite simple and did not fully capture all types of banking risks. Next, let's look at the key requirement of Basel I. The main requirement was the 8% minimum capital ratio based on banks' risk-weighted assets. The capital was divided into two main types. Tier 1 capital refers to core capital such as equity and retained earnings, while Tier 2 capital includes supplementary capital such as certain hybrid instruments and loan loss reserve. Basel I also classified assets according to their level of risk. For example, cash and central bank reserve had a zero risk weight. Residential mortgage had 50%, while private sector debt and certain other assets had a 100% risk weight. So, the higher the risk weight, the more capital the bank would generally need to support the asset. Finally, let's look at the advantages and disadvantages of Basel I. One major of advantages is that Basel I created the first global standard for bank capital requirements. This helped improve public confidence and contribute to greater financial stability. It also provides the foundation for the development of Basel II and Basel III. However, Basel I also quite simple in the way it classified risks. It mainly focused on credit risk and did not adequately consider the other risks, such as market and operational risks. Because of this limitation, Basel I was not sufficient to address the more complex risk faced by modern banks. This weakness eventually contributed to the need for further reform, particularly through Basel II and later Basel III.
Next, I want to explain about Basel II. Basel II is a set of international banking regulation introduced in 2004. It was developed to strengthen Basel I by providing more comprehensive guidelines for minimum capital requirements and regulatory supervision. The main purpose of Basel II is to improve risk management and transparency in the banking sector. There are three main pillars of Basel II. The first pillar is capital adequacy requirement. This pillar set the minimum amount of capital that banks need to maintain to cover the risks they face. It focuses on credit risk, market risk, and operational risk. For example, when a bank gives a loan to a customer, there is a risk that the customer may not repay the loan. Second is supervisory review. Supervisory review ensure that banks assess their overall risk and capital adequacy. For example, if a bank is taking too much risk, supervisor can review its risk management, and require the bank to take action. Last, market discipline. This pillar promotes transparency through disclosure. Banks must disclose information about their risk, capital, and risk management. For example, investors can use the information provided by the bank to understand the bank's financial performance and risk. Next, let's look at the advantage and disadvantage of Basel II. The advantage of Basel II is improved risk assessment. Banks can identify and measure risk better. Second, it provides flexibility through the internal ratings-based approach. Third, it puts more emphasis on capital adequacy, which help banks cover possible loss. Overall, these advantages help banks manage risk more effectively. However, Basel II also has some disadvantages. First is complexity. Basel II can be difficult to understand and implement. Second is the reliability of rating models. If the models are inaccurate, risk may not be measured correctly. Lastly, its principle-based framework may lead to differences in implementation. Therefore, banks need good system and proper risk management to apply Basel II effectively.
Next is I will explain Basel III. Basel III is an international standard introduced by the Basel Committee on Banking Supervision in 2010, response to the 2008 global financial crisis. Its objective is to strengthen banks in the term of capital, liquidity, and risk management. There are 5 key features. First is the higher capital requirement, which mandate that banks hold sufficient capital to absorb losses. Second is the capital conservation buffer, which serves as a capital surplus to act as a cushion during period of financial stress. Third is liquidity coverage ratio (LCR), which ensures banks hold sufficient liquid assets to meet short-term needs. Fourth is the net stable funding ratio (NSFR), which ensures banks have a stable long-term funding sources. And the last one is the leverage ratio, which limits excessive debt usage to reduce banking risk. The next is advantage and disadvantage of Basel III. In terms of advantage, Basel III is help mitigate banking risk through the capital and liquidity control. It also strengthens the banking system, making banks better prepared to withstand financial stress while enhancing overall financial stability. However, there are also some disadvantages, which is implementation costs are high because banks must meet the stricter requirements. Smaller banks may face difficulties due to their more limited resources. Furthermore, Basel III requires continuous monitoring to ensure ongoing compliance with the established requirements.
BCBS and Islamic Banking. BCBS stands for the Basel Committee on Banking Supervision. It is the primary global standard setter for the prudential regulation of banks. Its main purpose is to strengthen banking regulation, supervision, and practice in order to improve finance stability. In Islamic banking, the principles of BCBS are also important because Islamic banks need to manage their financial risk while ensuring that the operation comply with Sharia principles. Application of BCBS principle in Islamic banking. First is capital adequacy. Islamic banks need to maintain sufficient capital to absorb potential losses and protect the depositor. Second is risk management. Islamic bank must identify, assess, and control different types of banking risks while considering the specific risks associated with Sharia compliant products. Third is liquid management. Islamic bank need to maintain sufficient liquidity so that they can meet their financial obligations with when they become due. Application of BCBS principle in Islamic banking. First is capital adequacy. Islamic bank needs to maintain sufficient capital to absorb potential losses and protect the depositor. Second is risk management. Islamic banking must identify, access, and control different types of banking risks while considering the specific risks associated with Sharia compliant products. Third is liquidity management. Islamic banks need to maintain sufficient liquidity so that they can meet their financial obligations when they become due. Lastly, effective supervision is important to ensure that Islamic banking operates in a safe, sound, and responsible manner. Overall, BCBS principles provide a strong foundation for maintaining the stability and resilience of Islamic banking. Next, I will explain the role of IFSB and how these standards are implemented in Malaysia. IFSB, or the Islamic Financial Service Board, develops standards specifically for Islamic financial institutions. It addresses the unique characteristics and risks of Islamic finance, support prudential regulation, and promotes financial stability. In simple terms, BCBS provides general banking standards, while IFSB provides standards that are specifically designed for Islamic finance. For the implementation in Malaysia, Bank Negara Malaysia or BNM play an important role. BNM applies prudential banking standards and regulators and supervises Islamic bank. BNM also ensures the Islamic banking comply with Sharia principles. The Sharia Advisory Council or SAC provides Sharia guidance for Islamic financial institutions. Therefore, Malaysia combines international banking standards with Islamic principles to create a strong and Sharia-compliant Islamic banking system.
Now, I would like to explain about the importance of the Business Commit on Banking Supervision or BCBS. Firstly, BCBS promotes finance stability. It develops global banking standards to reduce system risk in the finance system. It also helps banks to be better prepared during finance risk by having proper risk management policies. Secondly, BCBS treats risk management. It provides a comprehensive framework for banks to identify, measure, and manage defined types of risk, such as credit risk, market risk, operational risk, and liquidity risk. The BCBS framework also has three main pillars, which are minimal capital requirement,
severely review and market. Lastly, BCBS interbanking supervision. It provides important principles for central bank and regulatory authorities to supervise finance institutions effectively. It also encourages cross-border cooperation and information sharing, especially when dealing with multinational banking in group.
Next, I want to explain challenges in implementing BCBS standard. First, high compliance costs. Bank needs to spend more on compliance, reporting, and monitoring, which can increase their operational costs. Second, technology investment. Bank need advanced IT system to manage risk data and meet regulatory reporting requirements. However, upgrading this system can be costly. Third, lack of expertise. Basel standards are quite complex, so banks need skilled employees who understand risk management, compliance, and financial regulation. Another challenge is capital adequacy. Banks need to maintain sufficient capital to meet regulatory requirements. This may increase funding costs and potentially affect their lending activities. Lastly, regulatory complexity can also be a challenge because Basel standards need to be implemented through different national regulatory frameworks. Therefore, although BCBS standards are important for financial stability, implementing them can require significant financial, technological, and human resource. Thank you.
Okay, reflection from this topic. We learn about the role of BCBS in banking supervision. BCBS provides standards and guidelines to help banks manage their operation and risk. We also learn how BCBS help banks manage risk such as credit risk, market risk, and operational risk. Besides that, we understood the importance of capital requirements because banks need enough capital to cover potential loss and protect depositor. Okay, for last slide, in conclusion, we learn that BCBS plays an important role in international banking. So BCBS promotes effective risk management and encourage banks to follow proper banking standards. This help banks remain stable and reduce the risk of bank failure. Overall, BCBS help strengthen the stability of the global financial system. So, thank you.